Hello and welcome to another episode of Property Ponderings, the podcast where we dig deep into the world of property buying, selling and renovating, giving you property advice to ponder. My name's Craig Nicol, your host. I'm a licensed real estate agent in Melbourne, Australia, with over 15 years of property experience as an agency owner, property investor, renovator, town planner, salesperson, auctioneer and buyer's agent. I want you to make better property buying, selling and renovating decisions to build the future that you are chasing. Today's episode is all about planning your investment property purchase in the new year. With the property market constantly shifting, buying the right investment property requires preparation, knowledge and strategy. By the end of our chat, you'll have a clear plan for tackling your next investment property, including how to set financial goals, research market trends and identify strong performing suburbs. Whether you're a first-time investor or looking to expand your portfolio, today's tips will help set you up for success. So let's dive in and get one step closer to your dream property. So firstly, let's talk about starting with clear financial goals, because organising and planning for your investment property without financial clarity is not a good idea. So you've probably heard the phrase, failing to plan is planning to fail, and that's particularly true in property investment. Your first step should always be setting realistic financial goals. Ask yourself, what kind of return are you chasing? Is it rental yield, long-term capital growth, or a mix of both? What's your borrowing capacity? Speak to your mortgage broker to get pre-approval and understand your maximum loan limits. Also, what are your ongoing costs associated with owning an investment property, like council rates, insurance, property management fees, and maintenance? And how have you accounted for that within your planning and budget? From a financial planning perspective, it's also critical to consider your cash flow. Positive cash flow properties where your rental income exceeds your expenses are great for maintaining your financial health. Alternatively, negative gearing can work if you're confident in strong capital growth over time, as you'll benefit from potential tax deductions. So there you go. Understand your clear financial goals is really important if you're planning to buy an investment property in 2025. The next important part of it is researching market trends and opportunities. So once you're really clear on your finances, we need to look at opportunities. And this part requires a combination of research, strategy, and patience. So some really key trends to watch. So interest rates and borrowing costs. The Reserve Bank of Australia has indicated rates may remain elevated into early 2024. Some pundits are saying that there may be a rate cut early in the year, but more likely middle to late in the year. So no one really knows what's happening, but you really have to plan for the worst in regards to that. But keep an eye on this, because it's really wise to factor in this into your cash flow analysis. So higher rates can influence affordability and slow price growth in certain areas, but they also present opportunities where sellers need to offload properties quickly. So being aware of what's going on could give you a leg up. From an investment point of view, I think it's really smart to ensure that you're not going into buying a property assuming that rates are going to drop. I would be going in with a buffer that they could even rise again at some point. So that's just to ensure that you do have enough cash to be able to sustain an investment property. Always have to plan for the worst and hope for the best, as they say. Another key trend to watch is the market supply and demand. So according to CoreLogic's recent data, vacancy rates remain low across the country, sitting at around 1.1% nationally. This is causing an ongoing rental crisis, meaning strong demand for rental properties in many markets, which is great for those investors that are about to jump into the market. So it's important that you also keep an eye on the supply. So if you're talking about rental prices, just seeing how many rental properties are coming onto the market. It doesn't seem like there's any drastic changes in that regard from what I can see, but you also have to look at the market supply and demand for sales. So how many new listings are coming on the market? Is there a growing supply or glut on the market, which presents or often presents many opportunities? Or is the market starting to tighten? We may see that in Melbourne, listing values or listing volumes increase, but the actual take-up of those listings is quite strong, which is potentially holding listing volumes down lower, which could create a scenario where prices are starting to rise, or you may see listing volumes increase early in the year and then the take up isn't necessarily that strong, which could mean that more listings are sitting on the market and further opportunities are presented for that. So just being aware of what's going on is really important when you're about to buy an investment property, to understand where the opportunities are. So there's a few different areas where you might be looking for your new investment property. Some people may be looking in towards growth corridors that are benefiting from new infrastructure projects, such as new highways or rail links or schools, which can often attract families and workers, especially in the challenges of affordability at the moment. A lot of the more affordable areas are getting some strong demand all across the country, so it's something to keep an eye on, especially if there's new infrastructure. And the other thing is just looking at state government infrastructure plans to identify these potential places to invest. You may be looking as well into regional markets in the new year, so many regional cities like Ballarat in Victoria or Newcastle in New South Wales continue to see strong growth due to the affordability and lifestyle shifts. So these areas could deliver higher rental yields than many of the metro markets as well. And the other obvious place to look as well is in towards the city and the middle ring suburbs, where there are plenty of opportunities. If we're talking about Melbourne at the moment, where a lot of family homes in the city and middle ring suburbs haven't been performing that well over the past couple of years. So the reversion of values there may see people starting to jump back in, and we could be already starting to see that with interstate investors especially coming into Melbourne, where they're seeing really good value in certain areas, and the inner and the middle ring suburbs are looking quite good as well. So all in all, what I'm trying to get at here is just research what's going on in each of these different sorts of segments of the market, whether that's growth corridors or regional markets, inner city houses and middle ring suburbs. Understand what's going on, what's driving growth, what's changing, to see where your opportunities might lie. The next thing to talk about is understanding how can we identify stronger performing suburbs. So how do you actually pick a winning location? And here are a few indicators just to remind you that I often use to spot a stronger performing investment suburb. So the first one is population growth. So look for suburbs experiencing above average population growth. So more people can often mean a greater demand for housing. So we know that Victoria particularly has had a very strong migration of new people into the state, and although this hasn't shown on price growth as of this stage, I believe, and a strong believer that over the long term this will continue to push prices up, and trying to chase where that population growth is occurring is really important. And if you can see that on a suburb level where there's opportunities, then that could be a really good indicator that it's somewhere that you might be able to get a really good investment. Just note here that a lot of the more established suburbs aren't necessarily going to have a huge amount of population growth because they're already so established, but you'll find that many of the established areas actually have new apartments and new multi-unit dwellings that are occurring. So the population growth is still occurring there, and that sort of demand, or those people coming into the area, actually, from my point of view, increases the demand of properties that are sitting on large parcels of land that potentially could be developed, or other properties that may not be the ones that are actually being developed in those areas. So as more population comes in and there's more high density going on, the people that aren't the high density, there is that greater scarcity that's being created because there aren't new big homes that are being built. So that's a factor of population growth into these areas. The other factor is rental demand. So have a look at SQM Research, realestate.com.au, and check out the vacancy rates within the areas. I like to keep an eye on a week-to-week basis on suburbs that I'm investing in to see what the vacancy rate's doing, see what properties are renting for, and see if there's any major changes that are occurring. So you can really get ahead of the the rental demand in the area and seeing if it's growing, weakening, and try to chase those trends and really understand what's happening. The third thing to consider is the median price growth trends. So reviewing median price growth trends over the last sort of 3 to 5 to 10 years, just to check if a suburb has had consistent growth rather than these volatile spikes. It just means that if you can get suburbs that have had that longer term growth over a long time, that they're safer bets for long-term investment, that trend will keep going on. It's no guarantee, and there are other factors to check, but it's just one of the many things to look into to understand how the suburb's moving. You might currently have a few suburbs flagged that have had really strong growth just over the last year or two, and then it really hasn't shown much before that. And then that might make you question whether the suburb is just going through a short-term spike. Will prices revert to a lower price, or is there a reason why they're higher? So trying to get an understanding of that is great. And median price growth movements just give you a bit of a loose indication of what's going on there. The fourth thing to look at if you're trying to identify some strong suburbs is just understanding the proximity to amenities. So we know that tenants look for convenience, but also for capital growth reasons, you want convenience because those are the properties that are most sought after often. And so suburbs close to public transport, schools, employment hubs and shopping precincts, they can attract more renters and maintain property values strongly into the future. All right. Now, one of the things that's important to cover off on is the common pitfalls to avoid. So you're about to purchase your investment property for the year of 2025. Now that we've sort of had a chat about some brief thoughts on strategy, let's talk about a few common mistakes investors make and how to avoid them. So the first one is skipping due diligence. So make sure that you're always researching a property thoroughly before purchasing. So use property inspection reports, rental appraisals, and growth forecasts to get a really good understanding of what's happening. But then more specifically, we're thinking building inspections, looking at government websites to understand zoning and overlays, other factors that may impact the property. You might even look into information on titles if we're talking about a specific property, covenants, all that sort of stuff needs to be looked into. And anything that you don't know about the property and you're not putting the time and effort to find it out before you purchase, then expect that a surprise could occur later on that could cost you a lot of money. So skipping due diligence is a big factor that I know a lot of investors skip, and it costs them a lot of money. It's an instant regret for many people. So that's the first one. The second one is just overestimating rental returns. So just because a property is advertised with a high rental yield doesn't mean that is guaranteed. And just because a property nearby that is similar had a high rental return does not mean that you'll also get that as well. So you have to compare numbers against real market data and just adjust for any vacancy periods or differences with properties, or you have to really be digging into why or what rental return you're actually expected on the property, and then try to then work that into your potential budget and costings into the future. So this sort of ties into overestimating general returns as well, like just growth on a property. Make sure that when you're looking at a certain suburb, if we're looking at the median price value movement over the past year or two, it's very difficult, or it'd be pretty naive to expect the same return in that period or in the next 1 or 2 years as well. It's not how things work. So understanding that will help you hold on to a property for the longer term and not make the mistake of simply selling it after a year because it hasn't returned exactly what it did a year ago, which was quite impressive. So that's one of the big things. So overestimation, I think a lot of that's just to do with expectations of going into your first property as well. So the more information you have before going in, then the expectations will be more accurate and more realistic with what's actually going to happen, so that you do stick to your investment strategy for a longer term to get the rewards that you will eventually get. The third common pitfall to avoid is ignoring maintenance costs. So older properties, they may look cheaper, but ongoing repairs can eat into your cash flow. So factor these costs into your investment strategy. The same thing goes for newer properties. If you have a newer property, you can assume that there's less maintenance costs, but I wouldn't do that. You've got to see what sort of work is required on an ongoing basis and check the quality of the fittings, fixtures, finishes, all of that sort of stuff that you have in the property to ensure that you don't have strong maintenance costs. And that's why that building and pest inspection is so important when you're buying the property, and really getting to understand every facet of the property as much as you can and as much as is realistic before you buy the property. Now, the fourth mistake to avoid is chasing the hottest market. So buying in a market that's already booming, it often means that you're paying top dollar. So instead of aiming for areas with growth already occurring, you need to be looking, I believe, at properties that offer growth potential before they start performing, or before they hit well into what you would call a hot market. I think that's why there's a lot of dangers jumping into areas, say, that have performed well this year, like Perth or WA and Queensland, let's say in general, have performed really well. We've got a lot of people that talk about buying investments and buying up there, and I think that even though those markets may well keep continuing to perform and certain segments perform differently, you've got to understand that there's a risk of jumping into a market that has performed so well over long term, because the later you're getting in, the more danger that there is there, whilst you're looking at markets that haven't performed as well in other parts of the country, such as Melbourne, for a few years now. And they offer opportunities to maybe buy at a point in the market where, yes, it could go down a little bit further, but I believe that the ability to buy into these areas mitigates your risk a lot more from paying way too much. Because if you've paid too much for a property, then in a market that does dip suddenly or flatlines for quite a long time, I think it's much more dangerous being in that position than being in a market that's already turned down and could go down a little bit more, yes, but it has much greater potential in my eyes to jump back up and increase in regards to your investment in the property. So just be wary of chasing the hottest markets there. I think that's a common mistake that people do make. All right, so just to recap on the episode, so planning for an investment property purchase in 2025 for the new year starts with firstly setting clear financial goals and understanding your borrowing power. Secondly, researching current market trends, interest rates, and supply and demand dynamics. Thirdly, identifying suburbs with strong growth indicators like population trends, low vacancy rates, and infrastructure investment. And then fourthly, avoiding common investor pitfalls like skipping your due diligence or chasing overheated markets. By taking these steps, you'll set yourself up for a financial year ahead and ensure your next investment property aligns with your long-term financial goals. All right, that ends another episode of Property Ponderings. I hope that's given you a few small tips to be able to make better buying decisions on your next property purchase. If you want to discuss anything further from this podcast, or if you're wanting to get tailored buying or renovating advice, please feel free to contact me on 0400 122 081. We'll chat again soon. The information provided in this podcast is for general information purposes only and does not constitute financial, legal, or investment advice. While every effort is made to ensure the information shared is accurate and up to date, it may not apply to your specific circumstances. Listeners are advised to seek independent professional advice tailored to their personal situation before making any property, financial, or investment decisions. Nickel Buyer Advisory and Craig Nickel disclaim all liability for any decisions made based on the information discussed in this podcast. Property markets are dynamic and outcomes can vary depending on factors such as location, timing, and economic conditions. Always conduct thorough research and consult with trusted professionals before taking action. By listening to this podcast, you acknowledge and accept this disclaimer.